Semiconductor stocks in the US are now in a bear market officially because they're down 20%. But if you buy into this pullback, you could become handsomely rich. We cover everything you need to know. Welcome to the Daily this Monday, the 10th of March. My name is Jessica Amir, a market strategist with Moomoo. It's great to have your company. And thank you to those who are tuning in to our podcast. But first, let's cover what you need to know. With Trump's 49th day as US president, I guess the important thing is what we've learned is the importance of diversification. The fact that we've got the market's fear gauge as measured by the VIX at one of its highest levels in 12 months suggests that, fear is pretty high, but we do have to remember fear brings opportunity. This is a chart of the VIX that shows it's at a reading of about 23 at the moment. But the fact that this is this high is a good reason why investment managers are continuing to rotate money out of high growth tech stocks and then moving into defensive investments. For example, at the outset, we spoke about the VanEck Semiconductor ETF. That's down 20% from its high. So this tracks a lot of the stocks that are in the semiconductor sector, those big names that you know like NVIDIA, Intel, Broadcom. But nevertheless, this is reflecting that this ETF is being punished at the moment. It's down 20% from its record all-time high. And this is at the same time as the healthcare sector rising 25% this year, while the agricultural and farming machinery sector is up 18%. The gold index and the gold sector itself is up 18%. All I'm saying is this scenario suggests that retail investors will now start to seriously seek out these sectors that are offering growth, while other sectors, such as the one on the screen, are experiencing pain amid fears about economic growth slowing. At this stage, I think it's also important to point out that the market is awaiting tariff dust to settle. No one likes the fact that one day tariffs are on, the next day they're off. But the elephant in the room is, of course, we are all awaiting details about tariffs of the imports of all chips coming into the US and when that will come into effect and the details of that. Once we hear that come out, that'll probably pressure stocks and the semiconductor sector at large. So do you buy into the semiconductor ETF now like SMH, given that it's fallen under its 200-day moving average? Yes, this is a very bearish signal. The last 4 times the semiconductor ETF has fallen under this 200-day moving average, there's been continued pressure, as in the market this ETF has continued to fall. But then we saw an eventual rebound to a record all-time high. The biggest pullback of this ETF over the past 5 years was one of about 40% from peak to trough. So that is something to consider. That was in 2021. So why did this ETF fall by 40% then? Well, stocks were under pressure back then because there was fears about economic growth slowing, there was fears of oversupply of chips, and also fears about US interest rates. But right now, we don't have those scenarios. So we do have NVIDIA saying that they can't keep up with demand. Broadcom can't keep up with demand. And also the US market is expecting the US to cut interest rates, and that's because economic growth is expected to slow. So all I'm saying, folks, is that you might not expect that pullback of 40%. So what other pullback might be realistic if we consider this ETF? Well, what about 2018? That's the last Trump trade war. Well, in 2018, this ETF actually only fell 29% from peak to trough. Yes, it was painful. It was 6 months of red, but those who bought into the pullback were rewarded after the market sharply recovered, and this ETF hit a brand new record all-time high after just 2 months and 21 days. So all I'm saying is, if you consider buying into this pullback right now, given that this ETF is down 20%, you might be handsomely rewarded and become handsomely rich if you take a long-term view. What about the Aussie share market? Well, the Aussie share market is expected to perhaps have a fruitful day. We'll wait and see what happens. But earlier, the futures were suggesting a lift of 0.8%. A stock that I'm watching is the one on the screen, XYZ. Why am I watching this? Well, for those that missed it, we broke the news on Friday. The US government approved Bitcoin to be a key strategic reserve asset. On Tuesday, we'll find out if the US government is going to start buying Bitcoin. Remember, they already own 200,000 Bitcoin. If we don't see the US government say that they are indeed going to buy more, or when they're likely to buy more, you might expect Bitcoin to potentially fall $10,000. And that means this stock on the screen might come under some pressure. But that is something to consider. We've put a note on Moomo's platform as to why the Bitcoin price might potentially fall from where it is now, around 80,000 to 74,000. So do keep an eye on this stock on the screen, because this stock, XYZ, formerly known as Block, do make a fair chunk of their cash from Bitcoin. This is a chart of the Aussie share market that is showing that we have continued to come under pressure. And indeed, the Aussie share market is now one of the worst performing stock markets globally this year. It's down about 2.6%. So we are one of the worst performing markets. In fact, we're the third worst performing market behind the NASDAQ and Japan's Nikkei. But this week we've got plenty of catalysts that could move the market higher, or they could pressure the market lower. We hear US inflation reports. We also await news about more jobs data. We'll wait to see if US job openings are improving. But if we do see, I guess, weaker than expected news, we might see the market being pressured here. That is something for you to consider. What else are we watching this week? Well, tech investors locally and globally will be getting some catalysts from two key earnings that are released. We've displayed those on the screen. For those that are listening in, we're just basically showing the Oracle and Adobe expectations. So both of these big tech majors are releasing earnings. They could excite tech investors if we see stronger than expected earnings. And what we're displaying on the screen right now, for those that are listening in, is the broad consensus is that their shares remained strong buys. So have a look at Moomo's platform and you can see what the average price target is. You can go and have a look at the earnings expectations. Speaking about other earnings to watch, lithium and copper stocks are on watch, as well as Tesla, which is now down 50% from its record all-time high. But we will probably get an earnings catalyst because the battery giant, Contemporary Amperex Technology, also known as CATL, they release their earnings to the market. If we see a stronger than expected outlook from that company, we could see some excitement into local lithium copper stocks, as well as Tesla, which is listed in the US. Bit of a long report today. Thanks so much for your patience. Have a wonderful Monday, and thanks for tuning in to Moomoo. From all of us here